Hi, I'm Patu from freefincal. In this video, let's talk about a question I received on Twitter. Which category of mutual funds is best suited for retail investors keeping risk and performance in balance? That's a great question. I always have respect for investors who focus on categories because they have a system of selection and choice in mind, and that's always great. So before we talk about this, I just want to quickly point out that the May 2019 freefincal equity mutual fund screener is now available. You can use it to shortlist the most consistent equity mutual funds. You can get the link from the description box. And so before we talk about categories, what is needed and so on, we should have a risk versus reward map of mutual fund categories. And I had created some kind of a map like this in September 2017 when I wrote when to choose what mutual fund using the then categories. Some categories have changed, but many are still the same. Before I show you the results, to give you an idea of how the risk versus return scales, scales, I will show you how to get these numbers and then how you can create your own mental image of category risk reward. So let's head over to value research, and this is quantum liquid fund. And if I'm in the performance tab, if you scroll down, you will be able to see this risk measures, and you have a fund mean of 6.18, standard deviation of 0.15, category mean of 6.62, and standard deviation of 0.447. What this means is that over the last 3 years, they've taken the monthly returns, taken the average of the monthly returns, and that average they've projected it as an annualized return for the fund as well as the category. And this is the spread in the monthly returns. This is a measure of the spread in the monthly returns, also projected as an annualized average. This means that over the last 3 years, Quantum has given a monthly return which is equivalent to 6.18 plus or minus 0.15. So that's like a very, very small change in spread. Don't assume that it is the monthly return is 6%. They have actually annualized it. So the monthly return will be, if you actually look at the monthly returns, these are the monthly returns, see the monthly returns, they'll be like 0.45, 0.48, that's the kind of monthly returns you will get every month. But when you average it, when you annualize it, average and then annualize it, you will get about 6%. So it's like saying over the last 3 years, or if you push it a little bit and say over every possible last three years in the past, typically the returns is about 6% with a small fluctuation of about 0.15, 0.2%. That's you can push it a little bit and say that. So that's the spread in the returns possible. So in the past, I'm talking about the past, so it is reasonable to assume that in the future too, I can expect about 6% from quantum liquid. With a small spread, small fluctuation because of market risks and so on. The category is also 6.62 plus or minus 0.47. So that's please recognize that it's taken from the monthly returns, but it's a reasonable expectation to have from liquid funds as a category. Now, go over to HDFC Top 100, which is representative of a large cap equity fund. If you go over to the same numbers here, look at the numbers here. This is 16.35 plus or minus 13%. That's like saying 16.35 plus or minus 13%. That's the spread. Look at the category spread, 14.11 plus or minus 12.69. So that's all over the place. So over 3 years, if I want to choose HDFC Top 100, it's not a suitable investment because I don't know what kind of return I will get. The spread in return is so much, the volatility is so much that I have to be prepared for high returns or high loss. But whereas over 3 years, if you look at a quantum liquid fund, it's just 6.18 plus or minus 0.15. It's a very, very small amount. 6.18 plus or minus 0.15. It's almost like nothing. I can almost reasonably expect about 6% return from quantum liquid or any other liquid fund over the next 3 years also. So that is the risk versus reward map I'm talking about. You can do it for all the categories, and I have done this in September 2017. I can do it again, but somebody else can also do it. It will be nice if somebody can do it and send this to me. It's a very simple exercise. So what I've done is you can see the categories listed here in the vertical axis, and in the horizontal axis is the return, that 6%, that average of the 3-year return. So those are represented by the returns are represented by the red balls, and you can see this horizontal line. That horizontal line is that plus or minus spread. As I said, 6% plus or minus 0.15. That's somewhere here. Whereas for large cap funds, it's like saying 12% plus or minus 13, something like that. So that's the spread here. Notice how the vertical line for liquid funds is actually within the red ball, then the vertical line comes out a little bit and comes out a little bit, and it's like very, very large spread for the equity funds as you go from large cap to multi cap to large and mid cap, small cap, and then all the way to sectoral funds. So that is essentially the risk map. I can't give you a reward map, but that's it. So if you go after such risk, you must be prepared. You can't. People keep saying you can expect 10% from equity over long term, 15% from equity over long term, and so on. No, that's not true. It's like saying 10% plus or minus 10%. That's the kind of real spreads that you will see. And of course, in this map, some funds are missing, the new category. Some funds should be removed. For example, the gilt short term does not exist anymore. You have a new category called liquid fund, overnight funds, which are even more or less volatile than the liquid funds. Then credit opportunities funds are now essentially credit risk funds. And then there is a banking and a PSU fund separately. Earlier, they were part of the income funds. Dynamic bond is still there. Gilt medium and long term is still there. All the others, these are more or less still there. And so on. So that's the so you must have this kind of a map in place. Of course, in the hybrid category, we will come to that. So what I want to do, I want to see another table where I have actually put this the average that you see and the standard deviation. So you can see 7.42 plus or minus 0.34. So these are category averages. Of course, at that time. Now it will not be so different. It's altered. Some of them are missing. So these are debt funds. You can see that I've now categorized it as low risk. So it's suitable, more or less suitable for 3 years. Then you have the medium risk, 9.74 plus or minus 3, 10 plus or minus 4, 11 plus or minus 5, and so on. And then it's suddenly, when you go to equity funds, you have the high risk. From 11 plus or minus 5, which is the gilt funds, it suddenly becomes 14 plus or minus 14. That's a huge jump, or 11 plus or minus 13. That's a big jump. So that's the jump from the green to orange is a small jump. As you go to longer debt funds holding longer bonds, you will get a bigger spread in the returns possible on the volatility. But as you go from orange to red, that's a huge jump, and that's when it happens when you go from debt funds to equity funds. I have a question today. Somebody said you have assumed that debt funds are have a fixed return. Yeah, the reason for that, I do that when I do a back test, because compared to equity funds, the debt fund return is almost fixed. Relatively speaking, the risk in equity is so much higher that I can almost practically treat debt fund return as fixed in the back test. Of course, reality it will not be the case, but that's so. What about then there are hybrid funds like aggressive hybrid funds, that is the equity oriented balance funds, balanced advantage funds, and the multi-asset funds. They will fall right in between this orange and red. Aggressive hybrid funds will be closer to the red. Multi-asset and balanced advantage funds will be a little bit lower, but please recognize that it will be only a little bit lower. So diversified equity risk will be here, aggressive hybrid equity risk will be here, multi-asset balanced advantage fund will be a little bit lower. So that will be like, so in between, so it will be like a light red or a deep orange. So in between these two will be hybrid funds will be there. So this is the risk map of the mutual fund categories that you should first be aware of. Now let us answer the question which has been asked. Which category of mutual funds is best suited for retail investors keeping risk and performance in balance? If you are looking at short-term goals, stick to the green guys, stick to liquid funds, overnight funds. Don't if you can handle some credit risk, choose ultra short-term funds. Other than that, don't do anything else. If you are asking for the long term, then as part of a diversified portfolio with a clear asset allocation, 60% of funds, 60% of your portfolio for a retail investor can be, I would recommend, in aggressive hybrid funds or balanced advantage funds or multi-asset funds. These are the three categories that I will recommend. The risk will be somewhere in between. I apologize, they're not actually there in the graph. I have it somewhere else. I've written too many posts that I cannot find them quickly. They're somewhere in between. I can link out to another post in the description box where you can actually see this better. So that's what I would recommend. Those are the three categories that I would recommend. For those who do not mind this a little bit more risk, they can go to multi-cap funds, or they can go to large and mid-cap funds and so on. Or you can have a large cap fund, mid-cap, small cap. That's also fine. Those are all possibilities. But for a retail investor, most retail investors will say long-term 10% return is okay with me. I don't want too much risk. Then stick to aggressive hybrid funds. If you are okay with a little bit less return, then go for multi-asset or balanced advantage funds. You can do that if you are. So, for example, okay, let's put this into better context. Let's say you have a 15-year goal. Choose aggressive hybrid fund. 60% you can have exposure to aggressive hybrid fund. Suppose you have an 8-year goal or a 10-year goal. Choose a balanced advantage fund, but have only 50% to 40% exposure to a balanced advantage fund. Rest you must have it in fixed income. So that's the kind of choices that you can make, that a retail investor can make. But please recognize, understand risks first, and then you can start investing. Don't focus straight away on the fund. That's a big mistake that everybody does. So that's what I wanted to convey in this video. I think let me check if I can show you very quickly the if I have done this. Yeah, I hope I have. This must be it, I hope. Some of these things don't come out right. Aha, something is happening. Let me just go to images. Yeah, this would be yes. This is what I wanted to show. Something seems wrong. I don't know what, but I can show you. I'll make this bigger. I think my server is not responding well. Okay, let's just quickly show you. So you can see here, increasing risk. The aggressive hybrid funds are somewhere here, just a notch below, and then you can find the other funds, other categories somewhere on this slide. So let me link out to this post. I'm not able to show you. So that's what I want to. Okay, I have a server error right in the middle of the video. That's very nice. So that's what I wanted to say. Let me link out to these videos, and I'll catch you again. Apologize for not being able to show this. I'll catch you later. Bye.